Good morning, ladies and gentlemen. Well, the title of this week's presentation is What If? And what if everyone is wrong and the PMIs don't mean a thing and we are actually going to get a turnaround in an acceleration in world growth in 2020? Would explain a lot of things that are going on in the market at the moment, and we shall examine that evidence. The risk model is still in risk on, the scores are low, it's basically on the borderline between dividend stocks and balanced growth, but we are getting continuation of new highs in the moving average divergence. We've been basically stuck at these levels for best part of 2 weeks, but the weekly model has made a new high. So basically on a weekly basis we are still diverging and accelerating the divergence, and we are going, as you can see from these figures here, we're going to ever higher values, and that is undoubtedly bullish for risk on, i.e. the differential between bond returns and equity returns. So no change there, and we are still very much in risk on. Divergences are also expanding, as you can see, and the market is very much in this quadrant that's slowly ascending. You can see here that basically the resistance comes in around the 3190 area in SPX. If we look at the sectors, nothing really to XLE might be turning higher, so that's supportive of Russell, but it's still in a downtrend. I would not be surprised actually over the next couple of weeks to see it move into the red. I like Russell and that would encourage me, but the most important ones are to me XLU, which is now rolling over and is saying that bond yields are actually going to go higher. And the other one that I find very interesting, apart from XLK, which is in a very nice slow uptrend, are XLF. XLF is accelerating higher, and as you will see later, XLF has actually taken out a very important high that's been here for 2 years, and now has room to rise to around 31 or slightly higher. Now that's a 2 to 3% move from these levels, and that is to me what could be driving the market higher. XLV I don't understand. I think that is probably something that will retrace at some stage. I really do not want to know about XLV because the dangers of it politically are far too high at the moment, I feel. And XLP, as you can see, is very much in the red, and I expect XLP at some stage to come back. The one I like because it is early is XLY. We have quite a bit of room to the upside, and then slowly it'll start diverging and opening up. Whenever it closes down like this, a big move can be inferred, and if the big move is to the upside, that would mean that the US consumer is nowhere near tapped out, and that we have a lot of room on the upside. As far as the Blue Angels are concerned, we're getting the first movement up in expectations of earnings or forward earnings, and I will really not be surprised to see the market touch the times 18 at around 3200 quite soon in the, quite possibly this year. That is what the market is doing. Every time it dips anywhere near the times 17 line, lots of buyers. You have to respect that. Multiples can go up quite a bit. We had multiples well over 20 in 99 and 2000, so it is not hugely overbought. It is overbought historically since the great financial crisis, but if we look at before then, the expectations were far higher. So I would not really use this as an argument anymore for why we can't go higher. We can, and I certainly expect the 3200 level to be tested sometime this year or early next year. Before we examine the yields and the level and valuation of equities, I want to show you this chart, which is basically a chart of XLF together with a yield curve, and this is basically the differential between overnight money and 5-year money. Banks basically make more money the higher the spread is. They borrow overnight and they lend long. They lend in the 5 to 7 year area. So the higher this spread goes, the more impetus XLF has to go for higher prices. And here you can see this 30-33 level, which we broke on Friday, which was the absolute previous high of XLF for many years. If we now go and actually enlarge this chart, you will see that basically any and all upticks in the spread are actually matched by a move higher in XLF, which basically makes sense, because the higher the spread between what they make on their book, it directly goes to the bottom line. Every basis point immediately hits the bottom line of the banks. So here we have it. This is an argument to me for a higher price in XLF, but that would imply also a higher spread. How are you going to get to a higher spread? You're only going to get to a higher spread if you have a steeper yield curve. So now we have to examine what the yield curve is telling us. This is the 2-year note, and as you can see, it's basically been stuck in a 10 basis point range for a long time. As long as this remains below 171 and then probably below 180, it is going to basically mean that we are in a sideways range. You've probably remember my 5-year, which we'll show in a moment, and that's also saying that we are in a range. So the yield curve is going to steepen by 2s and 5s staying in a range, and 10s and 30s backing up. We are bound to get little movements up to 171, and if we do, I think those are better buys in futures than sells, simply because 90% of the move that we're going to see, if we see it, if I'm correct, will be in the longer end and very little in the short end. And here are the 5s. 177, 187. These are the magic numbers for the 5s. I think it's going to be very hard for the market to break those. If it does, then something big is going on, and actually the market is not only normalizing the curve, but it's actually saying that the next move is going to be higher in yields, something which nobody at the moment can foresee, and certainly something that no one is expecting. The world central banks are all in an easing mode, but the normalization itself is interesting, because that is saying that the market is no longer looking for such aggressive easing over the next few years, and that is per se supportive of a segment like the financials, because they naturally enjoy having much higher yields and spreads. If instead we look at a yield chart of the 10s, you'll see that it's nothing like the 5s. This is where the movement is going to be, and you can see that every time it's gone above 185, it's actually gone all the way back up to 233. That is something that would not surprise me. It would not surprise me to see the 2s and 5s stagnant and the 10s over the course of several weeks make a run up towards the 230 area, and that's that's a long way. We are 184. If they move up all the way to 230, that's a big tightening of conditions and a big causer of sectors within the market to move. Something like XLP, XLU will be big laggards, while XLF is going to be a big beneficiary. So that is something that really we have to keep our eye on. You can see how in the past, every time we've broken this 183 level, we have gone 184 level, we've gone to 230. That's a 50 basis point move, which it's like two tightenings by the Fed, which I'm not saying the Fed is going to tighten. I'm saying that the odds of a yield curve steepening in this environment, if we start getting better figures, it's really it's a 3-to-1, 4-to-1 play at the moment, looking for a steeper yield curve. In Europe, we're beginning to see the same thing. You can see how now for weeks the market in the bubble has been stuck between minus 52 and minus 62, a 10 basis point range, churn. The big signal is going to happen when we break that, isn't it? And here in the 10-year notes, the bunds, you will see this level is basically at minus 22. When we break minus 22, or we break this level, which is minus 38, we get a big move. We just have to know what those levels are and watch for a close above it, and then we know which way the market is going to go. And it will probably trend quite a while. If we break minus 22, I would not be surprised to see this kind of level, which is 5 basis points. Now that is big, and that also tells me that we have a danger also in Europe of a steeper yield curve. That is going to be very supportive for European banks. There's going to be a scramble to get on board the European banks, which is a sector which has been so badly beaten up over the years. The market is telling us something, and we have to respect what the market is saying, because it's just not going with the slowdown narrative. It's every time the market backs up even slightly because some weaker number comes out, buyers, and immediate return to the previous levels. That is something which tells us that the yield curve, when it starts moving, is going to be a real contributor to the beaten down sectors. Now, another level I want you to mark, and this is the differential between bunds and 10-year notes, is 196 basis points. We are now around the 210 area, which was always my objective ever since we broke this 245. 245 to 210, made good money, thank you very much, out. But now if we start going towards the minus 196 area and we start breaking it, then we really don't have any resistance until about these levels, which are 160 something, okay, around 170. So that's another, from here, 40 odd basis points. It could very easily be that the bund stays relatively bid. I mean, it has every reason to. You have a very nice funding differential. You have no issuance. You have QE, i.e. the ECB keeps on buying them. There are very few bunds available. The rules make it almost impossible for the pension funds not to own them. And it would make sense if we have a spurt of growth, primarily good for the US next year, and the Fed is on hold, that we see this transmission mechanism fall into the 10s and 30s and not in the 2s and 5s. Again, that is the steeper yield curve of which I'm talking about. And if the US goes, I showed you the chart of the 10-year earlier, how it spurts 50 basis points every time it goes through that level. This could be the big mover. Simply because it's just another confirmer of the theory. I always try to look at the puzzle from every which side, and that level, a break of 196, I think is going to be extremely significant and tell me that the States is going through a phase where 10s and 30s are getting hit hard. Gold is stubbornly holding on to the 1457 level on a weekly basis. You can see how it's now a month into it, just bouncing off it and not being able to rally. Now that is what is actually holding me in check to go absolutely all in on a high yield curve. It's it's basically saying not yet. I would not be surprised at some stage to see it break the 1457 area on a weekly close basis, and that'll give me the all clear signal. And when it does, slowly to make its way all the way down to 1360, because gold absolutely hates high yields, and the high yields will probably drag up the dollar, and in which case I really don't see much hope for it. I have over the course of the past couple of months reduced my allocation there, simply because I'm getting more and more bearish of bonds, and that is not really good for gold. It's still telling me respect the 1457 area, but I'm basically looking for it to close down below and then start moving towards 1360. If we look at the States, the equity markets, I mean, nothing bearish about this. I tried. Here I just knew that I was going to have to give up. And on Friday, those numbers really basically gave no hope to the bears, I don't think. You can see how close we are in the Bollingers. I showed you beforehand the what's happening in deviation, that leaves room towards 3090. But the weeklies are saying basically 3171 is when we close the week, and look at this, look at this candle. This is going to be around 3180 odd next week. And if we look at the monthly, it's still, what is it, 3 candles left, and basically we are 3172 is where the month is, but it'll be around 3180 if we get up there. So that is the kind of level that you are looking to absolutely respect, because even in a wonderful uptrend like this, it very much respects the monthly Bollinger Bands, and I have no reason to suspect it won't now. But for the trading side, anywhere around the 3180 level, you don't want to be long anymore. But what I'm trying to say is that this is this seems to be a continuation pattern of this, and if that is the case, the only way the market can go up is XLF, which has been such a laggard, and we'll have a look at it in a moment. And XLK is, the natural that would go with it, but XLY also has to do much better than it is doing at the moment. So this is XLF over SPY, and as you can see, it's been in a consistent downtrend all basically for 2 years just about, and now we are breaking out. The 200-day moving average in red is turning over. The 50 has crossed it. This is that blue line. And really, every time it's done some sort of a retracement, it's gone back to this 0.98 level. Would not really be surprised at all to see it tested. That means that XLF leads within SPY. Natural level to be tested above there, and I'm convinced, absolutely convinced, that the yield curve steepens and steepens considerably, with all that implies. It implies a stronger dollar, implies weaker gold, implies a complete shift in the sectors, away from defensives towards aggressive equities. It is really something which is going to move the markets a long way, and that the markets are not expecting, because at the moment you see what people have been buying. They've been buying XLP, they've been buying XLV, they're buying defensive, and they are completely badly positioned to take advantage of what actually could be happening, and the market is actually telling us that it could be happening. The last piece of the puzzle is actually to have a look at the markets which would most be affected by a slowdown in worldwide trade, and that is the DAX and also EM at a guess. If you have a look at the DAX, I mean, it's just done absolutely nothing wrong ever since it broke this kind of level, which is the 12,700. It just will not come back anywhere close to it and retest it. I thought wrongly last week they would come down some more. It didn't. It came back to within the closing range of the previous month. And all the meantime, the Bollinger Bands keep on expanding. I would not be surprised by year end to see 13,600. I really would not be surprised by that move. If we have a look at something like EM, which would also be a big beneficiary, it's the weekly chart, it's turning all the moving averages, even this 200 moving average positive. 4504 still remains the very, very important level. I mean, whether it's 4512 or 4504, who cares? It's still saying that the pressure is to the upside. Every time the market comes down to the 200-day moving average, buyers, boom, 43. That was a very good move. I love the buying it at 42. Up it goes, as I've been saying in the buyers table for a while. Every time it comes down to 42, I'm a buyer. And I still think that 45 is more likely than a break of 42. That is what I deeply think these charts are saying, and it's all arguing that the narrative of the slowdown is no longer active. Well, I've put here all the levels that are so important for the 2-year note, the 5-year note, the ones I expect to move least. 177 to 187. I still think it's attractive to even sell some puts at those levels, if nothing else. But the yield curve, I do think, is going to start moving and really favoring things like XLF. If on top of XLF, XLE energy starts moving as well, then that could really boost the Russell. You have all the levels. I still think Italy over Bund goes higher. I'm holding a small position in that, waiting for some sort of retracement, which never comes. You have VX. Such a wonderful sell on all the spikes. People rush in, they buy protection that they don't ultimately need, and volatility just dies. This is basically all arguments for a steeper yield curve and a higher valuation in financials, whether they be in Europe or in the US. Europe could be a particular beneficiary of this scenario, and it's very important to have all these levels marked, and I have them marked in my trade station. As soon as these levels are triggered, you just increase your level of exposure towards a steeper yield curve and a financial outperformance. Thank you very much indeed, and tweet you on Monday.